Here's something crazy. If you put this $100 in Amazon stocks when they first started selling it, that capital appreciation would give you $170,000 today. But if you put the same amount in pets.com, you'd have $0 today. And that's the biggest problem with money advice. Everyone is telling you to find the next Amazon, but that's same as finding the tiniest needle in a big haystack while blindfolded in the dark. Now, most money advice comes into two flavors. Either super complicated with big words that you need dictionary for, or too simple with empty promises about getting rich quick. But after looking at lots of research and testing myself, there's actually a middle ground that makes sense for everybody. Now, if you're tired of money advice that sounds like it was written by rocket scientists, or even worse, that sounds like somebody's trying to sell you some vague get-rich-quick scheme on Instagram, hit that subscribe button. Think of it as ways to grow your money without spending any money. Now, let's start with something that sounds boring, but it's super important, and it's called high-yield savings accounts. Here's something interesting. Scientists at Stanford found that people with emergency savings, what we call liquidity buffer, actually make more money when they invest in stocks. Sounds weird, right? Well, these scientists discover something really cool. When you're stressed about money, your brain actually works differently. So when you don't have any savings, your brain goes into something that is called a scarcity mode or scarcity mindset. And it makes it really hard to make smart money choices. Now, let's go a bit deeper and let me show you how these savings accounts actually work. So you make a deposit at the bank, and then that bank uses your money to make loans at maybe 7 to 8% lending rate. And then the bank shares some of this money that it earned with you, somewhere between 4 to 5%. And your money is protected by something called FDIC. Now, let me explain a bit more about FDIC because it's super important. So, FDIC stands for Federal Deposit Insurance Corporation. And think of it as government's promise to protect your money. They protect up to $250,000 in each account. So even if your bank completely disappears tomorrow, you're still gonna get your money back. And it's like having a superhero guard your piggy bank. Now, these accounts have different interest tier levels. Think of them as levels in video games. So you have level 1, level 2, level 3. And your interest rate actually depends on how much money you deposit in these accounts. So let's say that level 1 has from 0 to 1K, level 2 has from 1K to 10K, and level 3 has more than 10K. And the sweet spot actually is in level 2. That's where you get the best interest rates. Now, the cool trick is that you can spread your money across different accounts at different banks. So each account will get $250,000 protection, and you can actually get the best interest rates in different accounts. And thanks to new rules from 2016, your money grows through daily compounding instead of monthly compounding. It's like getting tiny bits of free money every day. Now, in 1973, a professor from Princeton called Burton Malkiel said something that upset everybody at Wall Street. He said that a monkey throwing darts at a stock listings could pick stocks as well as the experts. And everybody thought he was crazy. But guess what? 50 years later, research after research proved him right. And the most relevant is the one that S&P Global did. And what they found after watching 2,000 professional money managers for 15 years is that 92% couldn't beat the market benchmark. And when you include their fees, expense ratios, that number goes to 97%. And that means only 3 out of 100 professionals could beat passive investing. Now, think about that. Even people who study stocks all day, have fancy computers, and work at big Wall Street companies couldn't actually pick winners better than just buying everything together. And the idea of index funds was actually based on that. And here's exactly how index funds work. So instead of picking individual stocks, you buy tiny fractional shares of a lot of companies. So when you put, let's say, $100 in an S&P 500 fund, you get pieces of 500 different companies. And each piece might be just a few cents worth, but together you get broad market exposure. For example, maybe you're going to get 50 cents of Apple, 40 cents of Microsoft, 30 cents of Amazon, and tiny pieces of 497 other big companies, and all just for $100. And the clever part is how that fund updates itself. So when good companies grow, your fund automatically buys more through something called market cap weighing. And when companies struggle, they get removed from the fund during something called rebalancing. And now new, better companies take their place. And all of this happens automatically. You don't actually need to do anything. It's actually like having a robot gardener doing everything for you, like waters the good plants, removes the dying ones, plants new seeds, and it does everything while you sleep. Now let's talk why fees matter so much. So on one side, we have actively managed funds, which charge about 1 to 2% per year in expense ratios. So that's around $10 to $20 on $1,000 you invest. And remember, 97% of them don't do better than index funds. And on the other side, we have index funds that charge about 0.03% in annual fee. And that's actually just 30 cents for every 1K you invest. And let's look at what could happen over 30 years on a 10K investment. So you have a 10K investment, and active funds might cost you around 100K in fees over 30 years, while index funds might cost you around 3K in that same time period. And you do the math. That's $97,000 more in your pocket. Now, did you know that average millionaire has 20% of their portfolio in real estate? But buying properties is super expensive and takes a lot of work. And that's where REITs come in. And they have a cool story. In 1960, President Eisenhower made REITs legal for one reason only, and that's to let regular Joes like you and I invest in real estate. Before this, only accredited investors could buy big buildings, and the REITs changed everything. And here's actually how they work. So, a REIT owns and manages an investment portfolio of properties. Now, you can buy shares just like you buy Apple or Amazon stock. And the buildings generate rental income. By law, they must distribute 90% of their taxable income to shareholders. Now, there's something called SIPC, which protects your investments. And SIPC does the same thing as FDIC does for banks. Now, there are a lot of types of REITs, and some of them are residential, retails, office buildings, industrial, infrastructure, healthcare, and data centers. Now, regular people can't own all of these properties, but through REITs, you can own tiny pieces of them. Now, let's compare some numbers. On one side, you have direct property investment, which means you go out and buy yourself a property. Average return of that property is around 6.4% annually, but you handle all maintenance, you manage tenants, and it does require some capital, so high initial capital demand. And on the other side, we have REITs. And historical return of REITs is somewhere between 9 and 11% annually. You have professional property management, no tenant responsibilities, and you can start with as little as $100. They do have high liquidity, so when you need your money, you can pull back. Now, gold is like a great-grandpa of money. So it's been a store value since ancient times. And here's something amazing. 2,000 years ago, 1 ounce of gold could buy about 350 loaves of bread. And today, it still buys the same amount of bread. And that's not just luck. Researchers Roy Jastram and Jean-Pierre Allegoret, I think, studied gold's purchasing power over centuries. And they found something fascinating. While gold shows high volatility on short term, It maintains consistent value long term. It's like having money that doesn't get weaker over time. And actually gold has one cool trait, and it's called negative correlation with stocks. Let me give you some examples. During 2008 market crash, stocks dropped 37% and gold rose 3.4%. In 2020 COVID crash, when markets fell like 34%, gold jumped 28%. And this pattern makes gold a natural hedge against market risk. It's like having an umbrella for rainy days in the money world. Now, today, buying gold is really easy through something called gold ETFs. And here's how they work. Now, instead of buying actual physical gold bars or coins, you buy shares of a fund. Each share represents a specific amount of real gold, like 1/10 of an ounce. And that gold is stored at super secure vaults by big companies like SBDR and iShares. They keep massive amount of gold bars in their vaults, and those gold bars are checked by independent auditors regularly, so your gold is fully insured. Now, your investment in gold is also protected by SIPC insurance, just like stocks and index funds. And trading gold is really simple. You buy and sell instantly during market hours. You don't need to store or ship anything, and you can trade any amount you want. It's all the benefits of owning gold without needing your own vault. Researchers at Harvard found that a 5 to 10% gold allocation can help protect your portfolio during market stress. Think of it like having a financial emergency kit. You hope you're never gonna need it, but you're glad you have it when things go south. Now, in 2010, someone bought 2 pizzas for 10,000 Bitcoin. At today's prices, those might be the most expensive pizzas ever, worth over $400 million. But here's the thing, for every Bitcoin millionaire, there are thousands of investors that lost everything in crypto crashes. Yale researchers did a fascinating study about crypto. They actually found that despite extreme price volatility, sometimes 50% swings in a day, a small amount of crypto allocation could actually reduce portfolio risk. And you're wondering, how is that possible? Well, that works because crypto has low correlation with traditional assets like stocks, bonds, and gold. It's like having a completely random element in your portfolio, which surprisingly can improve diversification. Now, here's how crypto works. Instead of central banks, it uses blockchain technology. Think of blockchain as a decentralized ledger that thousands of computers verify. And when you buy crypto, you're getting digital tokens on this network. But remember, this is highly speculative. And if you want to approach crypto, there are a couple of steps you should follow. First, treat it as a speculative capital. Only use money you can afford to lose. It's like a lottery ticket. And limit exposure of your portfolio to 1 to 5%. And don't chase quick profits. Now, let's make this practical. Based on research, there are 3 basic different asset allocation strategies based on your risk tolerance. First strategy is conservative strategy, where 50% of your assets go to high yield savings accounts. Then 35% go to index funds, 10% to REITs, and 5% to gold. No crypto here. This is conservative strategy, and you're gonna play safe here. Second is called moderate strategy, where you have 30% in high yield savings accounts, a bit more in index funds, 45%, 15% in REITs, 7% in gold, and just a tiny bit, like 3% in crypto. And there's a bit more aggressive strategy called growth strategy, where you take a bit larger risk. So 15% goes into high yield savings accounts, 55% goes to index funds, 20% to REITs, 5% to gold, and 5%, so a bit higher risk, to crypto. And here's what's really cool about all this research. The best investment strategy isn't about finding the next Amazon or Bitcoin. It's about building a diversified portfolio that matches your risk tolerance and lets you sleep well at night. So remember, start with whatever capital you have and understand your investments. Also, know your protection like FDIC and SIPC that we mentioned earlier in the video. Maintain proper liquidity And please don't follow social media hype. The goal here isn't to get rich overnight. It's to build sustainable wealth over time. Thanks for watching and see you in the next one.